Hey guys, there's no doubt that the stock market can be a volatile place. This volatility can work in your favor or against you, depending on the type of trader that you are. If you're looking to profit in a volatile market, the one strategy that you want to consider is layering iron condors. In this video, we're going to discuss the advantages of laying iron condors and how you can use this strategy to make money in any market condition. We will discuss what is an iron condor, when you should use iron condors, what are the advantages of layering iron condors, and what are the risks with using iron condors. We're also going to talk about how many layers of iron condors you should use, the min, the max, and how you do it with a real world example. Finally, we're going to end with once you place the trades, how are you going to manage those trades? What is an iron condor? An iron condor is a directionally neutral, defined risk trade strategy that profits from a stock trading within a range before expiration. It benefits from the passage of time and any decreases in implied volatility. It's constructed by selling an out-of-the-money call vertical spread and an out-of-the-money put vertical spread. The ideal time to put this trade on is in high implied volatility. The max profit potential for an iron condor is the net credit received up front when the trade is put on, and it's realized when the underlying or the stock price settles between the short call and the short put option. The upside break even is the short call strike plus the credit received, and the downside break even is the short put strike minus the credit received. When should you use iron condors? An iron condor option strategy should be utilized when the investor feels that the underlying will stay within a defined trading range. And as mentioned, it's best utilized when volatility is high. This is because the option premium collected is much greater when volatility is higher. So what are the advantages of layering iron condors or putting on multiple iron condors? Layering iron condors can be a great strategy to use if you're looking to profit in a volatile market. By layering the iron condors, you're essentially increasing your chances of making money while also diversifying your risk. I like to start with placing one contract and allowing it to run until it reaches 50% of max profit. If the trade goes against me, then I'll go ahead and manage the untested side. In other words, if it goes against the put vertical spread, if it comes closer to the short strike, then I will roll down the call side of the trade, the call vertical spread, in order to collect more premium. When I'm at the point of having to manage the iron condor trade, this is the time that I will also look to put on a second iron condor in the same underlying at new strike prices centered around the current price in the same options expiration cycle. While the existing trade may be a loser, the new trade will be centered and likely help to balance out the trade at the new prices. This allows us to collect additional premium and decrease the loss or increase the profit. If the market's volatile, you can profit from the increased premium collected from selling the iron condors. If it stays range bound, then you can definitely profit. The advantage of using this strategy is it is defined risk. You know exactly how much is the max loss that you can lose when you put the trade on. It's also relatively easy to set up and manage. What are the risks of using iron condors? As with any option strategy, there are risks when trading iron condors. The biggest risk to iron condors occurs when the stock underlying moves outside of the expected range. This can happen for a variety of reasons, such as earnings reports or change in the overall market sentiment. If this happens, you will likely lose money on your trade. How many iron condors should you layer? When using stock options, it's important to stay small so that we don't blow up. We don't want to lose all our money in the account. A good rule of thumb is to not risk more than 3 to 5% on any one trade or one underlying. Of course, it depends on the size of your account. This is called position limit. A smaller account will not have the luxury of using as many trades or layering iron condors. This way, if we do have a losing trade, it won't have a large impact on our account. So to stay at less than 3 to 5% on each underline, we can backtrack and determine the max number of Iron Condor contracts that we can use in any given monthly cycle. For example, if we have a $50,000 account and we don't want to trade more than 3%, the max we'd want to spend on any one trade or underline is $1,500. Now, if the buying power for each of those Iron Condor trades was $500, if it was a $500 wide vertical spread, then the max number of contracts that we'd want to utilize would be three contracts. Now that we know the advantages and risk of using Iron Condors, as well as the max number of contracts that we will want to utilize, let's look at a real-world example. We'll use CVX, Chevron Corporation. We'll put on the Iron Condor when the price was $152. We sold the 140, 145 put spread, as well as the 160, 165 call spread, and we collected $290 when we put this trade on, which was the max profit. Now that the stock is testing our short put spread, we can roll down the call spread, or we can layer and place another Iron Condor trade on. Let's place another Iron Condor centered around the current price to bring our profit zone back to the center. So we will place the 130, 135 put spread and the 150, 155 call spread, which is a little delta negative. However, overall, this makes us neutral and we collect another $325 in option premium. We now stay in the profit zone between 135 and 160, which is much larger now that we placed the second Iron Condor on top of the first in the same options cycle. With the current price, you can see is at 146. How should you manage Iron Condors? I like to put on Iron Condors with about 30 to 45 days to expiration. I look to close the trade out completely when we reach 50% max profit. I like to manage Iron Condors when one of the short strikes is breached or tested. We manage Iron Condors by adjusting the untested side, or the profitable side of the spread. To do this, we roll the untested spread closer to the stock price to collect more premium. We can go all the way as to rolling the untested spread to the same short strike position as our tested spread, which creates an iron fly. When I'm at the point of having to manage an Iron Condor, this is the time to place my second Iron Condor trade in the same underline at new strike prices centered around the current price. While the existing trade may end up being a loser, the new trade will likely help to balance out the trade at the new strike prices. This allows us to collect more premium and decrease any loss or increase profit. When we get to the 15 to 21 days to expiration, we like to close out all of the positions. Of course, if the IVR is high, then we look to put the same Iron Condor back in the next options expiration cycle. How should we manage Iron Condors? I like to put on Iron Condors with around 30 to 45 days to expiration. I look to close the trade out completely when we reach 50% of max profit. I like to manage Iron Condors when one of the short strikes is breached or tested. We manage Iron Condors by adjusting the untested side or profitable side of the spread. To do this, we roll the untested spread closer to the stock price to collect more premium. We can go as far as rolling the untested spread to the same short strike as our tested spread, which creates an iron fly. When I'm at the point of having to manage an Iron Condor, what I like to do is place a second Iron Condor or layer a trade in the same underline at the new strike prices centered around the current price. While the existing trade may end up being a loser, the new trade will help to balance out the trade at the new prices. This allows us to collect more option premium to decrease our losses or increase our profit in most cases. When we get to the point of 15 to 21 days to expiration, I like to completely close out the options positions, and if IVR, implied volatility, is still high, then I'll put the same trade on centered around the current price in the following expirations month. Hey guys, thanks for watching this video to the end. Be sure and hit the like and subscribe buttons. It definitely helps me to produce more videos. By layering iron condors, you can have a great way to profit in a volatile market. You are essentially increasing your chances of making money while also diversifying your risk. When using this strategy, it's important to stay small and don't risk more than you can afford to lose. So if you're looking to profit in a volatile market, definitely consider layering iron condors. See you in the next one.